We've been discussing the drop in oil today after that early morning tweet from President Trump. The president tweeting, oil prices getting too high. OPEC, please relax and take it easy. World cannot take a price hike. Fragile. Let's talk more about these oil prices. I'm joined now by Larry Shover. He's Chief Investment Officer at Efficient Advisors, joining us from the Chicago Mercantile Exchange, the CME. Larry, why do you think this tweet appeared to have such a detrimental effect today on the prices? I mean, certainly you have to look at the context here that we've seen a rally in oil recently.
Yeah, great question. I mean, crude's up 21% year to date. And what's it up on? I mean, there are some legitimate reasons why it's up. I mean, physical markets are tight. I mean, diesel right now, the margin for diesel is unprecedented at $18 a barrel. Demand growth has been solid. OPEC Plus, by and large, has been very compliant. And think of like Iran, like export, the market was just deluged with supply from them before sanctions went into place, and we absorbed them. But right now, the last few dollars in oil is more about risk on and more about people fear of missing out, as they say, as well as the stock market.
Well, Larry, does the president have insight or know something that we don't? Because wasn't oil trading last fall around $72 a barrel?
Yeah, I mean, I woke up this morning and it was up a fraction. It didn't surprise me, given the stock market and whether the president has inside information. I really doubt it. I don't think anybody has enough inside information to drive long-term or even short-term oil prices, I guess. But what do I know? I mean, the fact of the matter is, a lot of non-fundamental reasons have gotten oil to where it is today. I mean, fully acknowledging margins are really high. But, right now, when you consider year-on-year industrial production numbers are negative in Europe and Japan. They're decelerating in China and U.S. Last week's global PMI global output numbers, 2012 levels. So maybe it's a wake-up call.
I think if a Trump tweet had the sort of impact on oil prices the way it has impact on everything else, I think the market wouldn't have moved much at all. The bottom line is the global economy is slowing down. So I think the strength that we have seen in oil prices, I think at some point is probably going to start fading a bit. And I think this is probably early signs of that.
Larry, you agree with that?
I do agree with that, and I agree with that, although I've agreed with that for a long time, and it doesn't always work out that way. I mean, the things that we see in front of us aren't always, as they appear, and you're dead right. I mean, that tweet today did cost the oil market a pretty severe correction on top of news that came out that Novak or somebody in Russia underreported their production figures for this month. So that combined with the fact that the market seems toppy, it's rallied, 3.5% in the last month on what? I mean, the numbers haven't gotten tremendously better. And, the API and EIA report numbers aren't showing anything that would be stupendously bullish.
Larry, how should someone play this through the equity side? You look, a lot of those fourth quarter earnings reports, Chevron, really good margins here. How should they approach this space right now?
Yeah, I think one of my favorite sectors is actually the energy sector, barring, just buying crude futures. I mean, I think relative to the S&P 500, they're cheap. I mean, relatively cheap. So I think on a pullback like this is a time to get back in. I do believe that the crude market will remain in a very broad, volatile trading range. But, within like maybe $52 and $60 a barrel with WTI, I know I'm the minority in that, but that's my firm conviction for 2019.
And we're listening to you, Larry Shover. Thank you very much. Atlanta Federal Reserve Chief Raphael Bostic.